Ladies and gentlemen, good day and welcome to Q1 FY'25 earnings conference call of HDFC Asset Management Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. From the management team, we have with us Mr. Navneet Manod, Mr. Naozad Sirwalla, and Mr. Simil Kanuga. I now hand over this call to Mr. Simil Kanuga, who will give us a brief, following which we will proceed with the Q&A session. Thank you, and over to you, Simil.
Thanks, Nirav, and good evening, everyone. The industry continued its upward journey and closed the quarter with AUM of 461 trillion rupees, signifying seven-fold increase over the last 10 years. To put things in context, the size of the mutual fund industry as a whole was about rupees 8 trillion as on 31st March 2014, and now we have seen industry adding over rupees 10 trillion in last 6 months. June 2024 was the 40th consecutive month wherein equity-oriented funds have witnessed positive net flows. Actively managed equity-oriented funds saw net flows exceeding rupees 1 trillion in the quarter ending June 2024, with rupees 262 billion of this amount contributed by 17 equity-oriented NFOs. Debt-oriented funds, including debt index funds, witnessed net inflows of rupees 709 billion for the quarter, marking a turnaround after 3 consecutive quarters of outflows. Additionally, debt ETFs saw net inflows of rupees 20 billion, bringing the total net new flows into debt to rupees 729 billion. Liquid funds also recorded an addition of rupees 510 billion during the quarter, again following 3 consecutive quarters of outflows. These flows in debt and liquid funds are similar to those seen in quarter ended June 2023. The following 3 quarters were net negative flows. Also, over the last 3 years, the debt and liquid fund categories have collectively witnessed outflows totaling to about rupees 2650 billion. Monthly SIP flows have continued their upward trend, rupees 213 billion for the month of June 2024. This quarter saw an addition of 2.3 million unique customers, new unique customers. Now we move to us. We surpassed rupees 7 trillion in AUM. Our asset mix has continued to further tilt towards equity, now at 64.3% on a quarterly average basis. On closing AUM basis, actively managed equity funds have grown to rupees 4.4 trillion, market share of 13%. Debt and liquid AUM has seen a Q-on-Q increase of 9% and 14%, market share of 13.5 and 12.7 respectively. We continue to be the most preferred choice for individual investors with market share of 13.3%. Our unique investor count reached 10.7 million, which takes our penetration in unique investor base to 23%. This quarter, we added 1.1 million unique investors and industry added 2.3 million. Systematic transactions for June 2024 stood at rupees 32.1 billion. About financials, our total income adds up to rupees 9483 million. Revenue from operations increased to rupees 7752 million, a growth of 35% YOY. Operating profit grew by 40% YOY. PAT at rupees 6039 million, a growth of 26% YOY. Thank you, and we can take questions now. Nirav, we can kind of start building up the question queue.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask the question. The first question is from the line of Bhavin Pandey from Athena Investments. Please go ahead.
Hi, good evening, everyone. Congratulations on a great set of numbers. I just had
Bhavin, sorry, your audio is coming a little feeble. Can you speak through the handset?
Yeah. I'm at the handset. Am I clear now?
Yes, thank you.
Yeah. So, congratulations on great set of numbers. First thing, so the employee benefit expenses, they have gone up. I'm assuming it's on account of variable payouts that happened in Q1.
So that's employee cost is a function of year-end increments, actual increase in the headcount. We added about from the Q1 of last year to Q1 of this year. There is a employee headcount increase of 280 people. We invest in learning and development, employee engagement, etc. So that's an overall increase. It's not just performance-based related.
Okay. And secondly, other expenses have also shot up. So what could be attributed to that?
Yeah, so the increase in other expenses is mainly on account of increase in general business related expenses. There was a new fund offer expense. There are certain KYC related expenses for mutual funds and outsourced service costs. So these are the 3 or 4 major heads where YOY there's an increase in expenditure. So we had a manufacturing NFO during the quarter, and that does have some extra costs. And we are sure you appreciate the NFO expenses are not bad in a sense that there is an additional AUM that will fetch us materially higher fees than costs incurred as we go forward.
Yeah. Okay, understood. And in terms of branch expansion, so we added 1 for this quarter. So would you like to give out some numbers in terms of annual addition that we could look at for FY'25?
No, we had 24 branches that we opened in the first week of January. I think in the next few weeks or few months, we don't have plans to add many more,
Okay. That was really helpful. Congratulations again and good luck.
Thank you, Bhavin.
Thank you very much. The next question is from the line of Ujjwal from Desvelado Advisory. Please go ahead.
Hello. First of all, congratulations on the great set of numbers. I have 2 questions actually. The first question is, currently I've seen that the percentage of asset under management in equity funds stands at 50%. That is up from approx 39% a year ago. I wanted to ask, can you elaborate on the strategic considerations behind the shift and share your projection whether this is likely to increase, decrease, or remain stable in the foreseeable future?
So I think the way we kind of look at assets are between equity oriented. So if you just add up the equity oriented asset for us is 64% odd. So we are nearing a 64-65% mark when you look at purely equity oriented assets for us. So you are saying where we expect this to go? Is that your question?
Yeah. Equity based, like the asset under management and equity, basically. So is it likely to increase or we expect it to remain stable considering in the foreseeable future? And if you can give any guidance upon the effect of it on the margin part.
So while we want to grow all our segments, but you would appreciate that in case of equity, the 2 variables, number 1, the mark-to-market gain would relatively be higher than other asset classes. That will push the equity proportion higher within our overall AUM. And second is the SIP book, which is now a very large part of the overall flows. So a large part, in fact, bulk of the SIP flows are into equity funds. So the equity proportion by that should increase at a faster pace. But as I mentioned earlier, our intent would be to grow all our segments of business, including fixed income and others.
Okay, got it. And my second question was could you provide any insight into any upcoming initiatives related to introduction of new fund offers? Specifically, are there plans to diversify or expand the portfolio to NFOs in the near term, in the near future?
No, we just had an NFO manufacturing fund which met with a huge success. After that, we had an index fund just 2 days back. We keep looking at our product bouquet, but to a large extent now we believe that our product bouquet is more or less complete. We've got the full range of products across both active as well as passive side to meet different kinds of investors' needs. But I consistently encourage the team to consolidate our position in our existing funds and try to aim for top 3 positions across categories. So I think, yeah, there may be few here and there, but I think to a large extent our product bouquet is full of both on active and passive side.
Okay, got it. Thank you. Also, best of luck for your future prospects.
Thank you.
Thank you very much. Next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Just asking on the question on employee expenses again. So even sequentially, when we look at the employee expense, that is up 17% Q1Q. So, what are the elements of ESOP expenses? Is there a element of ESOP expenses that have gone sequentially? Or what is driving this sequential increase? Because generally, I understand that your variable pay get amortized over the years, over the 4 quarters. So how do you read this, and how should we look at the run rate from here on?
So see, sequentially, the first impact of sequential increase is the annual increments we roll out, right, in the first quarter of the year. So that's one aspect of it. Also in the first quarter, we typically have the initial valuations that come across for leave encashment and all other purposes, benefits that go in. And typically the way it works is the valuation comes in, which is then which gets used up over the rest of the year. This first quarter, we also had a large employee engagement event, which we typically do in our first or second quarter of the year. So these are the elements. I would encourage that you look at expenditure on an overall basis for an annually basis. And on an annual basis, I think for employee costs, we broadly would be in line with what the market would expect between, say, 10-12%, unless we have a very large expansion of people, which we have done over the last 12 months. This year, we are still planning on expansion. Otherwise, I would just expect you to look at it on an overall basis, on a year-on-year, rather than on an annual basis, rather than a quarterly basis.
Okay. Secondly, on the tax rate, why is it low, and how should we look at it for the full year?
So we have explained this. Some of the assets that move from short-term bucket to long-term bucket, the DTA benefit comes through, which is why we had a similar setup in Q1 of last year, and some of it is also flowing to Q1 of this year.
Okay. Got that. And so if you start looking at from a yield perspective now, yield sequentially improved, and we guided also for improvement in the previous quarter. But how has been the NFO yield in this quarter, given the state of NFOs that have come in the market? How has been the commissions on NFOs? Has that been a increase in commissions? Because there are some market talks about some of the schemes getting yields at much lower rate than the existing book.
I think, Prayesh, more or less the newer NFOs that are happening in the market are happening in a range. It's not like something which is way off.
Okay. So in the past, what we had seen was NFOs were coming at a very high commission. That's not happening right now.
So the NFO commissions are higher than the normal commissions because that's what kind of tends to happen, right? The overall activity. But as of now, what we hear from varied players in the market, I think it has been fairly in a range.
Okay. And my last question is, will you give out the yields on each of the assets?
Sure. No, you're asking about the revenue yield on equity.
Yeah. So equity is just short of 59 basis points. Debt is being 28, fairly steady. Liquid 12, 13. So yeah.
Okay. Got it. Thank you so much. All the best.
Thanks.
Thank you. Next question is from the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Hi, thank you for the opportunity. So I had this question on, employee addition. So if you look at our, last 5-6 years employees, they were kind of, a number of employees, they were flat around 1150 to, 1200 mark. last 2 years we have seen reasonable increase in, number of employees, and Nausad touched upon, we are looking to hire more this year. Can you talk to us about, what are the areas where we are hiring these employees? And because, typically we would, like, nature of our business is that you don't need at least a large number of employees to grow our business. So, if you can, throw some light on areas where you've been hiring these employees.
So Kunal, as you are aware, we added 24 branches this year. This would have been like a substantial branch expansion after a long time. We have set up a dedicated channel to service HDFC Bank. This is a big opportunity for us over the next several years. Similarly, like we set up a few other dedicated channels where we see opportunity for us to grow. We have expanded our technology team, our digital team. We have hired 5 investment resources in our alternative business. We have ambition to grow our international business. So I think also roughly 280 odd people that Nausad talked about that we have added over the last year to meet all of those evolving business needs. In fact, I do see the need for further investment in the tech on the digital side, but they won't be like substantially large in numbers in terms of people. But yeah, that's where we would add some more talent. But a very large part would be in our core sales and client services in terms of numbers.
Sure. So when you talk about these branches, can you help us understand, what is the, concept of these branches? Are these like very large branches or, low, like large number of people in a branch? What would be the typical size and, how do you consider these branches in a way, from the unit economics point of view?
No, so the new branches we put up when we see a certain size where we can break even very quickly. We look at the overall AUM in that area and to service the catchment, relative to our distribution there. And these will be like 2-3 people branches, and most of them were in B30 locations. So the cost structure is not very high. You would appreciate that in most of these places, you don't pay a very high lease rental, or even the people cost is not very high relative to the potential. And I'm sure all industry data that you would be looking at over the last several quarters is a substantially higher growth, in a percentage growth, in B30 towns. And given our brand and franchise, pedigree, we believe there's a lot of potential for us to make the most of the opportunity that available today.
Sure. And like a further follow-up on this, like when we look at HDFC Bank, one big advantage, of course, is their branch network, right? They are like huge, largest private branch network in the country. Now, with our branch network and their branch network presence, how do, one read into it, like going ahead as well? And you talked about, adding employees for HDFC, bank channel. Can you talk more about it? What kind of support or, what kind of engagement that is?
No, we operate independently. People don't sit in those branches, but when we are opening branches or when we are hiring people, not only in these newer locations, but even in the existing locations, we keep in mind the spread of HDFC Bank in that area. As we have been mentioning over the last couple of quarters, that we are very excited about the opportunity that HDFC Bank as the distribution partner presents. The management team at HDFC Bank, I'm sure you have heard from them, has been very supportive of all our initiatives. They have a formidable distribution machine, and we won't leave any stone unturned to capitalize on it. In fact, I might have mentioned in the last call that we have a dedicated senior resource overseeing this relationship, and we have strategically mapped their branches and clusters with ours. And the strategic alignment has not only strengthened our relationship, but has also deepened our engagement level. And I'm personally very involved on a regular basis, even across levels and functions there in HDFC Bank, and I can clearly see there is a lot more alignment.
Sure. Thank you. One question was from our annual report, right? We talked about the fact that, we are taking strides from client service to client delight. Can you talk more about it, give some anecdotes, pointers, which can help us understand how, what and how we are, making this journey from client service to client delight?
No, many things. We need to constantly keep benchmarking ourselves, the way we are servicing our partners, the way we are servicing our clients. And we have done a lot of benchmarking exercise over the last 2 years or so. And based on the feedback, both, what has come out of this benchmarking exercise and even otherwise from our people on the ground, we have continuously been trying to upgrade our service levels to them. Be it in terms of training of our people there, be in terms of the way we respond, reducing the turnaround time for every the request from the customers. There are many things that we have done. There is tremendous focus on how do we digitize all our operations more and more. We regularly keep looking at the percentage of transactions, both the financial transactions and non-financial transactions that come in the digital form, so that how we can reduce the turnaround time as well as improve the client experience. We initiated an MD award system, which is a fairly objective one, and there is a very healthy, I would say, competition among various zones and clusters to kind of outdo each other in terms of providing better service to their clients. And a lot of this is also driven by the huge amount of analytics that we are putting in place to kind of like measure our effectiveness. And looking at like each channel, so the way we serve, let's say, our mission distributors who work through the subbrokers, the way we service our banking partners, the way we service our mutual fund distributors who have been very important but very large in numbers, the way we service fintechs, so on and so forth.
Sure, that's helpful. And one question, like as a MD and CEO of an asset management company, when you look at our business, from a near-term perspective, where markets are on a slightly overvalued zone, like they are, continues to be on the overvalued trajectory. Some pockets are like maybe in bubble zone. How do you look at, because our earnings from a year or 2 years perspective, because the equity portion has become like one of the highest in our own history, like 64% of our total assets, right? How do you look at earnings from a 2 to 3 years perspective? Because at the end of the day, equity markets are cyclical, and there are reasonable probability that markets may correct in because of any reason that we don't know today. Any thoughts on how you look at this?
So we all take a lot of pride and do this self-congratulation in the industry in terms of the way AUMs have grown. People mentioned about that number that the growth in last 6 months is almost same as maybe the AUM which was there a decade back or so. But we also need to keep in mind that still a very tiny proportion of household wealth is coming to mutual funds. All said and done, while we have added good number of investors in last 3 or 4 years, but the still total count is 47 million, 4.7 crores. Even if we look at number of investors who are participating in capital markets directly, there's still a lot of potential for us, and I'm not going into all the other numbers that we think should be our potential client base. One of the heartening feature of this growth over the last couple of years has been a large part of the money is coming in the form of SIP. That gives us a lot more confidence about the longevity and sustainability of this growth. Unlike some of the previous cycles where people will look at this product more as a bull market product, and then they look at entering in the market and then booking profit. This time is very different, and the way product is getting sold and a lot of contribution has been made by the MP's campaign of Mutual Fund Sahi and all the efforts all of us are putting to educate or to educate investors or to increase the awareness about building wealth by systematic investing over a long period of time. So that gives me a lot more confidence about sustainability of this growth than most of the previous cycles. Of course, there would be cycles. I don't think that equity market, you know this better. None of us believe that equity markets can deliver returns in a linear fashion. There would be quarters or years where markets will witness higher volatility than what we have seen of late. But I think the efforts in the industry is to ensure that investors don't get swayed by the volatility. This time we continue to ensure that investors invest in a highly disciplined manner, and we create a great experience for them over a long period of time that they can participate in India's growth. Another interesting thing I'll add that while you look at the growth on the equity side, but on the fixed income side, the industry hasn't grown much over the last few years. In fact, this quarter was good, but the previous 3 quarters were negative. So was the case last year. The same quarter last year was positive, but before that, couple of quarters had negative flows. So we haven't seen flows in fixed income. There is, over a period of time, potential to look at that asset class also.
The line for the participant dropped. We move on to the next participant. Next question is from the line of Swarnam Mukherjee from B&K Securities. Please go ahead.
Hi, sir. And thank you for the opportunity and congrats on the great set of numbers. Yeah, is this better now?
Yes, slightly better.
Yeah, so I just wanted to congratulate the management on the great performance. So I have 3 questions. First is on the employee expense side. Just wanted to confirm that the number that was reported this quarter, whether that has any component of variable cost coming from last year. It doesn't, right? Okay. So variable cost, the accounting method would be prorated across 4 quarters. Would that be correct, sir?
Yes.
Okay. And also, sir, if you could give me the number of what was the ESOP cost that was part of this employee expense this quarter, and how should we think about it for the full year?
It is there on the note. It's about...
So last year, the June quarter last year was 11 crores. This time it is 6.3 crores.
Understood, sir. Also, sir, in terms of the margins in the flow, if you could give me some color. I think on the stock you have said it is 59 bits in equity. What would that be on the flow?
So Swarnab, that remains constant. What we've been always stating, right? The flows do come in at a bit of a discount to the book. So depending on the product which sells more during the quarter, it does range anywhere in the range of mid to late 40s or something, or maybe sometimes 50s and slightly higher.
Yes, sir. Was there any impact of the NFO that we concluded this quarter on the number that we have reported? And can that kind of unwind going ahead?
Yeah, so as you are aware, I mentioned earlier that we did this large NFO, HDFC Manufacturing Fund, and we did almost 9,500 crores. It is larger. Now, there is a technical challenge with the NFOs whenever we do it. We are generally able to estimate NFO raise fairly in a range most of the times. So this time our team anticipated that we would collect somewhere in the range of rupees 3,000 to 4,000 crores, and we announced brokerages accordingly to our partners. And to our positive surprise, the acceptance of the product was way better, and we ended up, as I mentioned earlier, nearly 9,500 crores. So yes, lower TER and accordingly lower margin for us. Though I would say a very good problem to have. Instead of collecting 3,000 crores and making few basis point higher, if we have got 9,500 crores, few basis point lower, in absolute terms, that's a larger amount. So we do expect the margin to rise from year 2 as we have sort of stepped down structure from second year onwards. The fund, in fact, the fund continues to see healthy flows post NFO also. So June and AUM stood at around 11,800 odd crores. Some part of it's mark to market, but flows are good too. And these new flows are coming in at AUM aligned commission. Now that we know this is the AUM, so automatically commission get aligned. So over a period of time, as we get more flows, and as I mentioned, the step down structure from year 2, we do see it getting better from where this is currently. So this NFO would have, this NFO alone would have reduced our equity margin on total equity AUM by nearly half a basis point. But as I mentioned earlier, I'm not complaining about it. It's a good problem to have. In fact, I must mention this, that you have seen some of our past NFOs, we have done the same at a very healthy margin. Actually, in some of the NFOs, our margins were higher than our book margin. So from that perspective, this one is an outlier, and mainly because we ended up collecting a lot more than what we envisaged in the beginning.
Right, sir. Understood. Very helpful. So the last one from the industry point of view, so I think in the last 3 months, as an absolute number, we have seen some amount of, SIP discontinuation rates in the industry going up. Although it is still much lower compared to number of SIP accounts getting added. But just thought I, take your views on that, whether to, what should we read into this?
Hey, Swarnab, it can be even the other way around, because what might happen is if a particular fund is not performing well, people will shut the SIPs there and go to another fund. So those things also will get really factored in. But I think the way we watch this number is look at the absolute monthly flow number in SIP. And that number is growing month on month, right?
Right. Understood, sir. So for our organization, are we seeing any such kind of trend or it is fairly steady?
So for us, I think the numbers have been fairly strong when it comes to systematic transactions.
Okay. Understood, sir. Understood. Thank you so much and all the best.
Thanks, Arun.
Thank you. Next question is from the line of Abhijit Sakare from Kotak Securities. Please go ahead.
Hello, good evening, everyone. My first question is on yields. So when I look at, let's say, a sample of top 4 or 5 funds, which I guess, would be attracting more than 50% of net flows, it seems like, the distribution commissions, if you look at it in, basis point terms, seems to have, remained broadly unchanged over the last 12 months. Our understanding would have suggested, maybe given that adjustment happens not on the back book, but on the incremental flows, at least, some, pass through of the reduced TRs to the distribution commissions as well. So if you can tell us, what's the underlying, dynamics that are driving this? Is it the, contribution of SIP or, general, market trends or anything else?
No, Abhijit, but it is getting aligned. So if you look at it, I don't know exactly how you kind of have mapped this data, but it is getting aligned. Also, the very fact that SIP also, it is the commission rate applicable on SIP is on the date of transaction. So whatever commission is applicable on a lump sum purchase, on the new purchase happening, SIP goes at that rate, not any kind of a pre-contracted rate.
Okay, you're saying the SIP commission rates on SIP is same as the rest of the book, right? There's no difference because of that.
On the new flows. On the new flows.
See, on the new flows, that come in the form of SIPs, yeah. But your point on the book, I mean, we have seen the distribution commission versus the trend in the TER. Of course, there is a gap, and I think the team is thinking of various options on how to deal with the speed of this fall. As you know, I've been mentioning that this is a happy fall in margins because AUM is growing at a much faster pace. So in absolute terms, this is good, but statistically, you are seeing lower margin. Are there ways to manage this? A bit early for us to further expand, but all I can say is we are evaluating all possible options, and we will further expand on this once we have clarity internally.
Understood. And second one was that, generally, your comments around, SIP book starting to contribute meaningfully last couple of years. Is it possible to, share any numbers, of the new customers that we are getting? How many of them would be coming to us through the SIP route itself? And this is, question in the context of, there seems to be a lot of, performance chasing that has come, into the mutual fund industry as well. So I think that would be a, useful data point to have.
So out of the new customers that we would have added 10 million in this quarter, how many of that? Good number of them. So all I can say is whether it's the lump sum flows, the investors, the new unique investors who are getting added to the industry in terms of putting money in a lump sum form, or investors who are starting with an SIP, in both of them we have a very, very healthy share.
Mm-hmm.
And the second part was that performance chasing. Of course, we have always been saying that performance is a critical component in terms of investors' choice of funds at that point in time.
Got it. That's all from my side. Thank you so much.
Thank you.
Thank you. Next question is from line of Devesh Agarwal from IIFL Securities. Please go ahead.
Good evening, everyone, and thank you for the opportunity. So my first question is around other expenses. You did mention that there were certain NFO expenses and all that in the quarter, which I'm assuming you don't expect to get repeated in the following quarters. So in that light, can you highlight what would be the one-off in this quarter, which you don't think will be repeated in the following quarters?
One of the bigger one was the NFO cost, Devesh, for the quarter that we incurred. We don't spell out specific cost for each item. But I think, again, I would encourage you to see it on an annual growth basis, and generally, that's the way to look at other expenses as well. I think we have been broadly saying 12-15% type of expense growth expectation on an annual basis.
Understood. Secondly,
If I can come in, I mean, our total costs are sub 200 crores. So every additional 2 crores increase, our cost goes up by 2%. And look at the scale of the operations that we run. And I'm sure you would agree with the growth prospects that we have, not only in the mutual fund, but in alternatives with PMS on the international side. And even on the mutual fund side, there's a lot more, I think, that we can do to expand our market. So I would say that this is a healthy investment in the long term, rather than looking at pure cost in one quarter.
No, I agree, sir. Secondly, sir, you did mention about the asset-wise yield for 1Q. Can you give me similar numbers for the exit run rate as on 1st of July? What would be the numbers?
So this is blended for the quarter, and I think this is, that's what we typically disclose. And I think it should be fine for the being. We are happy to disclose this for a quarter average basis for the time being.
Okay, sir. And sir, if we were to understand in terms of HDFC Bank asset for FY'24 end, what was their total mutual fund book, and of that, how much was invested to HDFC AMC?
Yeah, around 30% in the book. But as we have been saying, our flow share has been higher, both in SIP as well as overall.
And what would be the size of the book, sir, for HDFC Bank?
So you're talking about the equity book or the overall book?
The one that they invest in mutual funds.
No, but on the equity mutual funds or everything?
Everything put together.
So if you look at it, right, we have disclosed of the total AUM, they are 6%. They are 6% of our overall AUM, right? So if you look at our AUM of June 2004, they are 6% of that. So you'll be able to just get that number.
And we have also put the number for the equity AUM, 7.7%. Yeah.
Understood. And lastly, sir, if you were to talk about growth opportunity, other than the general market growth that is applicable for everyone, the way I look at it, one is NFOs, which you said that more or less we have already completed all our offering. There would be some, but nothing big. And the other is this HDFC Bank, where we can see the increase in the market share. Other than these two, any other opportunities that you can call out, which you will be targeting for
Devesh, in our existing funds, I think several of them have tremendous potential to grow. There are so many of our products where we may not be among the top 1 or 2 or 3 players in that particular category. And message to the team is we need to, we must have, our endeavor should be to have a leadership position in all of that. Now with style diversity, we have different PMs with different styles, managing different kinds of funds. And we need to ensure that not only at the overall level, but we should look at granular level. In every channel, every product, every zone, we look to expand in our current set of products.
Right, sir. Understood. Thank you so much, and all the very best.
Thanks, Devesh.
Thank you. Next question is from the line of Raghavesh from JM Financial. Please go ahead.
Hi, sir. Congratulations on a strong set of numbers. Sir, only on the top line yields. So last quarter we saw a one-off, and the expectation was that the yields would improve by around 2 basis points. I think the NFO explains around half a basis point of the decline. Are there any other one-offs that we can see in the yields, or this would be the trend going forward? Because if we see the quarterly average AUM is about 8% lower than the closing AUM. If the trend was to continue, we can see a stronger decline in yields in the coming quarters in this year.
No, sir, right. In fact, we mentioned about the adjustment in the previous quarter. So optimal would be to compare it to the December quarter. In December quarter, operating revenue margin there was 48 basis points, and for this quarter it is 46 basis points. But look at how the AUM has moved as compared to December quarter. Our quarterly average active equity AUM for December quarter was about rupees 3 lakh crore, and for this quarter the number is rupees 4 lakh crore. This is a 1 lakh crore increase in last 6 months. Now at each scheme level, we would see a drop of 2-3 basis points for every rupees 5,000 crores increase in AUM. The point that we have been making in last couple of quarters, purely as per the regulatory formula. Now, due to increase in AUM by about 1 lakh rupees, 1 lakh crores, many of our schemes would have seen an impact of 2 to 5 basis points and some even higher. Actually, the overall revenue margin would have looked even lower if our asset mix would have been constant, right? Because of this 1 lakh crore mark-to-market gain, the equity-oriented assets, which were 60.6% in December 23, for June is 64.3%. So part of the dilution has been set up by change in mix, and this is what we have always mentioned, that part of dilution will get absorbed in changing asset mix. Of course, these are intertwined. Increase in AUM of 1 lakh crore consists of material gain through a mark-to-market and not just flows. So if market goes up, our AUM will go up and vice versa. And fees or margins, as we know, are inversely correlated. But as I keep saying every time, that it is not a bad problem to have. I mean, margins would have looked exactly flat if there was no AUM. I mean, if there was no mark-to-market growth. So it's like absolute revenues over statistical margin. And we also mentioned about the manufacturing fund, where we added 10,000 crores, and that has led to like half basis point dilution on the overall book. But that again is like a good problem to have.
Okay, so other than that, no one else. So this is a trend which is likely to continue with the AUM gains as they come.
So that is one, of course. I mean, as I mentioned earlier in one of the questions, that we are definitely thinking of various options because the MTM growth has been so fast that how to arrest the speed of this fall. While, as I mentioned, in absolute terms we make more money, but still margins get impacted. And are there ways where we can manage this better? But as I mentioned earlier, that little early for me to further expand. But we are. I mean, the team is evaluating all possible options, and we will get back to you when we have more clarity internally.
I think only thing I would like to add here is also coming from the fact that every 6 months we don't see an increase of 1 lakh crore of AUM. So the speed of dilution has been more magnified because of a very rapid increase in AUM.
Yes, okay. Thanks, got it.
Thank you. Next question is from the line of Shreya Shivani from CLSA India. Please go ahead.
Hi, thank you for the opportunity. Most of my questions have been answered. I just wanted that clarification on the tax bit. Is this, I'm probably not able to understand this better, but is this going to be on an ongoing basis, or it's something that has happened in the past 2 quarters because of the move from short-term to long-term assets? I mean, if you could help us understand that better, and how should we look towards the coming quarters on that matter?
So actually, if you see it on an annual basis, it sort of evens out more or less, right? When the year-end changes, some of the assets do move from the short to the long-term market. So it's not like a annual thing, and it's not like that this effective tax will continue through the year. by the end of the year, it will get more normalized towards the overall company's tax rate.
Got it. So it's probably something which impacts you toward in your quarter end, some quarter end, right? Not something which normalizes over the year is what you're saying.
I think, Shivani, so what Naozad is saying is, so when we make an investment from the prop balance sheet, till it completes the period. So let's assume that we make an investment in an equity fund. For the first 12 months, it's a deferred tax needs to be accrued on the gains that have happened. For the first 12 months, it is classified as a short-term capital gain, and thereby the tax provision is made at 15%. But once it kind of crosses the 365-day number, it becomes a long-term capital gain, and there is a reversal of entry of that 5%, which reduces the overall deferred tax, and hence the tax efficiency kicks in. But as Naozad pointed out, it's not something that will happen every quarter. Over a period of time, it will kind of get back to the normal corporate tax rate.
Got it. Very useful. Thank you. Thank you for explaining. Yeah.
Thank you very much. Next question is from the line of Darshan Shah from Multi-Act. Please go ahead.
Yeah, hi. This is Akshat from Multi-Act. Am I audible?
Yes.
Yeah. So I had two questions. So, Naozad mentioned two things on employee cost as well as on other expenses. So on the employee cost, we said that, we should look at a full year basis, and on a full year basis, it should grow in the range of 12 to 13%. So this 12 to 13% growth in employee cost, is it including ESOP that we are guiding, or we should look at it more from excluding ESOP?
Yeah, it's all inclusive. It's 12 to 15 range I gave, and you can assume all including it.
Okay. Because in last year we had a higher ESOP base, and this year the ESOP cost is going to be lower. So the ex-ESOP employee cost this year could be slightly higher, right?
Yeah, that's why we are giving you a blended rate.
Right. And on the other expenses side, we are saying that we should grow other expenses in the range of, again, 12 to 15%. Historically, our guidance has been that we should look at other expenses, from pre-COVID till now, the growth rate was around 8 to 10%, and that should be our growth rate on the other expenses side. So now we've, changed it to 12 to 15%. So any, specific capacity building or gaps that we feel that needs to be, filled in, because of which we have upped this guidance of other expense growth?
Yeah, I think Navneet actually gave a very detailed answer earlier on the call, right? He explained the entire rationale of where the investments will go, the branch banking side, digital side, technology. I thought there was a very detailed answer Navneet gave. Probably if you will do the call again, you'll get the answer.
And also one more thing, if I may just add, if you look at even pre-COVID till now, our other expenses have been growing at the range of nearly 12% CAGR. So also the very fact, right, if you do a new fund offer, the market has expanded, look at the size of the business that has kind of come up, the opportunity in store. So keeping all that in perspective, and I think, I'm sure you would appreciate the fact, right, if things are not looking as good, expense curtailment is something that we would obviously act upon. We have kind of exhibited that very well during COVID times and even in past. But if there is a growth that is visible, and I think we always made this comment, right, we'll never shy away from spending money when the business opportunity is something that we kind of find favorable.
Absolutely. So the question was also from similar point of view that, we are being, mindful of the fact that the expenses that we've been adding, they are more variable in nature rather than being, very sticky in nature, because we all are, aware of the markets and the levels that we are at. So, the nature of the expenses are more on variable rather than being fixed or sticky in nature.
No, so actually on a lighter note, we aren't aware about where markets are going. So I think we would have exactly stated the same thing 12 months back. And if somebody would have lost out on the following 12 months, it was one of the so-called good times of Indian market. So one needs to be very, very cautious when you tread that territory, right? In sense, I'm sure you appreciate the fact, right? And I think Navneet did touch upon this point. We now manage upwards of 7 lakh crores. We have like 250 plus branches. We now have an alternate business that is getting set up. All of this is getting done for like sub 200 crores a quarter.
And 1,600 people.
Yeah. So I think we are definitely very, very mindful. And I think as an organization, we have been fairly tight-fisted when it comes to spending money. So nothing changes there for sure. But for example, if we feel that by hiring the right set of people in analyzing our data, that would help us immensely over a period of time in terms of doing business, I think that's a call we would like to take positively.
Our last NFO has made our product tally, to 100. And to put that number in perspective, in March of 21, exactly 3 years back, our total number of products we had on offer was 43. We have added 57 products in last 3 years to complete our product bouquet to meet investor needs of all kinds or needs of distributors of all kinds on active as well as on passive side. And of course, all the tech capability, the digital capability, the client services. Somebody asked about moving from client service to client delight. The new channels that have opened up or the opportunities that have come up our way, be it the HDFC Bank or some of the other opportunities. And of course, initial days, but we are investing in building the non-mutual fund business as well. And of course, on the international side.
Right. Sure. Thank you. That's all from my side.
Thanks.
Next question is from the line of Jayant Kharode from Jefferies India. Please go ahead.
Hello. Am I audible?
Yes.
Yes, sir, you are. Please go ahead.
Thank you for the opportunity. So 2 questions. First, on the wealth techs, can you just tell us what is the share of these wealth tech apps in your SIP count and SIP flows, and also
fintech,
how do they?
You're talking about fintech.
Yeah, fintechs.
Wealth tech.
Yeah.
You scared us here by saying wealth tech. So I was, but yeah.
Yes, sir. So and also our wallet share and market share. I mean, how is it in contrast to our overall market share, and how is it progressing in these apps?
So we don't give specific channel-wise market shares as such, but yeah, we can just definitely comment it's fairly healthy.
Okay. And sir, the total share of these apps on your SIP flows or any indication how big have they become for you?
So the more than half of the new SIPs in the industry come through fintech channels. Larger proportion of that come from B30 towns, and on the incremental SIPs that come, we have a healthy share. They are more prominent in the new SIPs rather than on the lump sum side, and our share over the last 3 years has been inching up. So it was lower on the lower side 3 years back, and almost every year it's been inching up.
Great. Sir, secondly, on the alts business, if you could help us understand now you've you've invested in that business, what are your timelines and expectations, and what would be the sort of early harvest or early launches that you see over there? Any clarity on your aspirations over there?
So of course, as of now, the biggest priority for us, the way the management bandwidth gets spent is continue to build our mutual fund business. As you are aware, the kind of growth that we have seen over the last couple of years, and in fact, particularly on the SIP side, so we put all our energy on that side. But at the same time, we are cognizant of the fact that over a period of time, this is another important opportunity for us, and we don't want to miss out on that. So we launched our fund of fund, investing into VCMP fund that has crossed 1,000 crores in commitments. And I'm very happy to see this progress over the last 2.5 years on this side. We have already started investing and have seen participation from 4 or 5 institutional clients and a little over 400 other individual clients. So definitely encouraging. And the way the whole portfolio construction on one side and the client engagement on the other side has been evolving. That makes us feel very happy about it. This is also helping us in terms of going up the learning curve on the overall alternative business. The second on our private credit team, which has joined us in last few months. So a product here over the next couple of quarters you would see. So we are laying foundation stones for our alternative business, and you will keep hearing from us on this front. On the PMS side, the business is building up slowly and steadily. There's a lot more that we need to do. There is potential on that side as well, and we are cognizant of that. On the international side, regarding our GIFT City subsidiary, we have received all the necessary approvals for the launch of funds and have started onboarding clients and distributors. So in alternates and international, this is our another focus area apart from mutual fund where we want to see further growth.
How much are you targeting from the GIFT City this year?
No, I mean, early days, the whole thing is evolving. We are very confident that over a period of time, with all the efforts that policymakers have been putting in and the structure that we have got and the setup that we have put in place, this will have a good opportunity over a period of time. But
Thank you.
It's difficult for me to share the target that we will have.
That's okay. Thank you and congratulations on a great setup now.
Thank you so much.
Thank you. Next question is from the line of Rahul Agarwal, individual investor. Please go ahead.
Hello.
Yeah, go ahead, sir.
Congratulations on a good set of numbers. My question pertains to the investment book, which declined on a sequential basis by 500-600 odd crores. So what is the further plan of deployment of this amount?
No, sir, that has happened because we have paid out dividends.
In June, we paid out dividend of almost 1,500 crores. So that is a fall you will see in the balance sheet.
You're saying what is the deployment?
And the deployment remains, the deployment schedule is already actually attached as part of the shareholders presentation. Sir, at the end, you will see the breakup of the investments made. That's available in your sheet.
My question is like such a big amount is standing on the balance sheet, so which is yielding us around 7-8%.
Right.
So my like for that only just 10%, which is in equity, that is in the part of the regulatory requirement.
Right.
Apart from, so I need to just want to know that the remaining 6,000 odd crores. So do we have any further capex plan, or do we have any plan for giving out dividend or buyback?
So, sir, for this year, the dividend payout ratio for March 24 was increased to 77%, which was 72% last year. Also, we have to adhere to the skin in the game, which is a SEBI formula. So, capital that is invested in our scheme, and that's something which we cannot touch, and that's the mark-to-market gain, which has to be reinvested. The treasury surplus is invested in largely debt mutual funds. We are obviously seeding our alternate platform. We have mentioned in the past that in our alternatives own alternate FOF, we have committed significant capital from the balance sheet that will get committed and deployed over a period of time. And we always keep evaluating any and all M&A opportunities that come through to us. Given our size in the market, we get to see every transaction. We have not done a deal over a period of time just because it is a function of valuation and whether there is a appropriate fit for us. But we do keep exploring all options on the strategic front as well.
All right. Thank you. All the best for the future.
Thank you. Next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi. Am I audible this time, sir?
Yes, sir.
Yes. So just two questions. Just wanted to get some sense of the distribution mix for that particular NFO, and was it materially different from your equity-oriented distribution mix on the back book? And second, your MFD mix in your equity-oriented business or AUM has been on a declining trend. So just want to get some understanding of whether is it the factor of other channels growing very fast, or you are seeing some amount of maybe counter share pressure. So in terms of the top 100 MFDs or top 1,000, the data that you track, if you can get some qualitative understanding on that.
I think, Dipanjan, one thing, I'll just take the second question and Navneet will expand on the first one. See, if you look at what has happened is if you look at last 12 months, the direct has gone up from 22.7 to 25.6, right? That is two counts. One is basically the mark-to-market change in direct is more favorable because of lower fees. And overall traction in direct has been higher. So if you look at that mix, it is not about we losing a share in a particular channel. It is about how the overall pie kind of shapes up because of the varied channels that does business for us. So if you look at national distributors has been more or less flattish over the last 12 months. The banks have been have picked up marginally and MFDs have gone down. So that would be the overall scheme of things. Nothing to do with losing a share in the MFD channel or anything on those counts. Does that help?
Yes. Just, Simon, if I can just, extend that point. So, let me ask you in a reverse way. If you can give a breakup of your direct mix in terms of, and I think Jayant also asked this, direct would be a combination of both, maybe direct money coming into some of the wealth platforms, maybe some of it through your own website, and maybe some others through the fintech partnerships. So, which channel would be probably growing the fastest, or some color on those parts?
So maybe I'll also explain you one more thing. See, what tends to happen is, of late, over the last year or two, we have also seen a lot of integrations of some of the MFDs into national distributors, so on and so forth. So what happens is, a MFD goes to a particular size, and he gets acquired by a national distributor. Now, he moves from the MFD part of the so he might be under the MFD in June of 2023, but in June of 2024, his assets would move because of the integration into the national distributor channel, right? So those kind of adjustments have also been taking place over the last, 12 odd months. Now, as yet, we have not got into dissection of the direct assets into RIA, into fintech, and the direct as it is known. So we haven't really gone to that level of disclosures.
Got it, sir. And on the first question on your NFO, origination mix, if you can shade some color.
Yeah, sure. I think
directionally would be similar. I think we have seen very good participation from all sets of distributors, be it bank, be it MFDs, be it all national distributors, be it fintechs, and of course HDFC Bank as a distributor. And investors who came directly. So there was very good participation from all distributors. Yeah, but still there would be some difference between the book and the incremental, because there are some people who participate in NFOs as distributors, some people who focus more on the existing funds. So some bit of difference, but otherwise directionally that would be in line. Yeah.
Got it. Thank you.
Historically, always NFOs, and even in this one, NFO, it is more distribution-led rather than direct-led.
Direct-led. So direct investors come later.
Got it. Thank you, Simon, and Madhukar, all the best.
Thanks, Dipan.
Thank you. Next question is from line of Mohit from Centrum India. Please go ahead.
Yeah, hi. Am I audible?
Yeah.
Yeah. Thanks for the opportunity. So basically, I was looking at the unique investors. So unique investor, I think the industry added around 2.3 million. And I think we have kind of, 50% market share, whereas, overall we have around 22%. So this distribution channel was, responsible for this kind of an addition. I mean, you could just throw some color on that.
So we are seeing in terms of the incremental client acquisition in all channels, our flow share is higher than our stock share in terms of client acquisition.
So also, see, this is not necessarily a market share in sense. The same investor might have invested. So this is a penetration in sense that the same investor possibly would have invested in 3 funds, right? For the first time, if he's invested in us, for us, he's a new customer.
Right. Yeah, no, I understand, but I just wanted to know, which distribution channel, whether it's HDFC Bank or MFDs, if you have some kind of a data on that.
All. In absolute numbers, fintechs would be very high, but otherwise all channels. Yeah.
Otherwise, fine. My second question is towards the debt. We have seen in the industry data that, we have got inflows after 3 quarters of outflows in the debt segment. So any particular strategy, we are, taking so that we could, further increase our debt portfolio as well?
So, I think it's a mix. Some part of flows at the shorter end, and we have seen some flows from the individual investors at the longer end who think that interest rates have almost peaked and there is a possibility over a period of time rates go down and they want to lock in these rates through duration products. But from an amount perspective, a larger proportion is at the shorter end.
All right. Thanks for this information.
Products like money market, ultra short, low duration, etc.
Got it. That was helpful.
Thank you. Next question is from the line of Gaurav Jani from Prabhudas Lilladher. Please go ahead.
Yeah, thank you and congratulations. First question is to Naozad. Naozad, if stripping off the ESOP cost, right, last quarter versus this quarter, there's been an 18 crore increase in the staff cost. So, would you like to call out as to how much of this is sort of, one time in nature and what's the normal run rate that we're looking at?
So there is I wouldn't call it one time. Some of the employee engagement events we do, sometimes they spill from one quarter to the other. Something may have happened in Q2 last year, happened in Q1 this year. So in that sense, it's not a one-off. It's just an inter-quarter issue, right? That's why I would encourage you to see on an annual basis. And it will just smoothen out over that period.
Sure, understood. The second question is, from a more structural perspective, right? So if I have to look at actually the kind of growth we saw in FY'24, right, in overall equity, and which is why our blended yields sort of shrunk by about 2.5 basis points. So obviously an outcome of decline in equity yields. Now, all things being equal, right, assuming a similar sort of let's assume that, similar sort of equity growth comes through, technically the revenue growth should actually be better than, the last time around that we saw, right? Considering that, with telescopic pricing, a lot of the funds would have reached a certain threshold. So just want to understand that.
Gaurav, if the AUM will go up, the yields will come down. No? The revenue, basically the SEBI telescopic pricing formula will tick off. So overall yields will come down. Profits, you are right. Profits will go up, but the basis points that you are referring to would, of course, come down.
No, sure. So what I meant is the pace at which they actually have been declining, that should actually reduce, right? So.
Yeah. Obviously, so if you look at the absolute numbers being same as a percentage of a higher denominator, it will kind of come down. Yes, the steepness of the slope will go down.
Yeah, correct. So what I just trying to understand that the kind of decline that we saw, assuming a similar sort of a growth, a same kind of decline may not happen in future. Is what I meant.
You are right. Yes.
Okay, perfect. Thanks. That's it.
Thank you very much. As there are no further questions, I'll now hand the conference over to Mr. Navneet Munot for closing comments.
No, thank you so much.
Thank you very much. On behalf of HDFC Asset Management Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.